Let's start with chapter number 11, International Financial Management. Question number 1. Write a note on Foreign Currency Convertible Bonds (FCCB). The money being raised by the issuing company is in the form of foreign currency. A convertible bond is mixed between a debt and equity instrument. It acts like a bond by making regular coupon and principal repayment, but these bonds also give the bondholder the option to convert the bond into stock. These types of bonds are attractive to both investor and issuer. Due to equity side of the bond, which adds value, the coupon payment on bond are lower for the company. Advantages of FCCB. Convertible bond gives the investor the flexibility to convert the bond into equity. Companies prefer bonds as it leads to delayed dilution of equity. FCCBs are easily marketable and minimum fixed interest earning. Disadvantages: exchange risk is more in FCCBs as interest on bonds would be payable in foreign currency. FCCBs mean creation of more debt and forex outgo in terms of interest, which is in foreign exchange. Question number 2. Write a note on American Depository Receipt (ADR). Depository receipt is basically a negotiable certificate denominated in US dollar that represent a non-US company's publicly traded local currency equity share or security. ADR is generally created by depositing the securities of an Indian company with a custodian bank. In arrangement with the custodian bank, a depository in US issues the ADR. The ADR subscriber holder in the US is entitled to trade the ADR and generally enjoys the right as owner of the underlying Indian security. ADR becomes an excellent source of capital bringing in foreign exchange. It is governed by the provision of Securities and Exchange Commission of USA. Apart from legal intermediaries impediments, ADRs are costlier than GDRs. Legal fees are considerably high for US listing. Registration fees in US is also substantial. Hence, ADR are less popular than GDR. Question number 3. What is the impact of GDR on Indian capital market? Impact of GDR on Indian capital market. Indian stock market to some extent is shifting from Bombay to Luxembourg. There is arbitrage of possibility in GDR issue. Investor need to keep updated with worldwide economic events. Indian retail investors are completely sidelined. Market of GDR. GDR are sold primarily to institutional investors. Major demand is in UK, US, Southeast Asia, Europe. Mechanism of GDR. Companies issue ordinary shares capped with custodian depositor bank against which GDR is issued to foreign investors. Characteristics: being ordinary shareholders, though they do not have voting rights. GDR are settled through CEDEL and Euroclear International Bank Entry System. GDR are listed on Luxembourg Stock Exchange. Trading takes place between professional market maker on an OTC basis, freely traded, marketed globally without being confined to borders. Investor on fixed income by way of dividend. Risk is with investor. Investor may get GDR cancelled anytime after a cooling off period of 45 days. The price of ordinary shares of issuing company prevailing in BSE or NSE on the date of advice of redemption shall be taken as the cost of acquisition of underlying ordinary share. Question number 4. Write a note on instruments of international finance. Euro convertible bond and other source. In other source there are 8 types of bonds: Euro bonds, Euro convertible zero bonds, Euro bonds with equity warrants, syndicated bank loan, euro bonds, foreign bonds, euro commercial papers, and credit instruments. So first start with euro convertible bonds. It gives the holder of bond an option to convert the bond into predetermined number of equity shares of the company. May carry two options: call option, put option. Other sources ma first euro bonds. That instrument not very attractive. Euro convertible zero bonds. No interest is payable on bonds. Euro bonds with equity warrant carry a coupon rate. Warrant are detachable. Pure bonds are traded at discount. Fourth, syndicated bank loan. Large loan from bank with good credit rating. Maturity up to 5 to 10 years. Interest rate is generally set with reference to an index, say LIBOR plus spread. Euro bonds in a currency issued outside the country of that currency. For example, yen bond floated in France. Foreign bonds, which is foreign bonds are denominated in currency which is foreign to the borrower and sold at the country of that currency. Such bonds are always subject to the restriction and are placed by that country on the foreigner's funds. Euro commercial papers, maturity less than 1 year. Credit instrument. Operation of bank consists primarily of purchase and sale credit instrument. The price and rate of each instrument therefore varies with extent of loss of interest and risk of loss involved. There are therefore different rate of exchange applicable to different type of credit instruments. Leading versus lagging. Question number 5. Leading means advancing the payment, making payment before it's due, and lagging involves postponing a payment, that is delaying payment beyond its due date. Decision regarding leading and lagging should be made after considering likely movement in exchange rate, interest cost, and discount if any. Question number 6. Netting. Reducing administrative cost, transaction cost resulting from currency conversion. It is technique of optimizing cash flow movement with combined efforts of subsidiaries. Netting helps in minimizing the total volume of intercompany fund flows. Advantage: reduce number of cross-border transaction, decreasing administrative cost, decrease transaction cost, gives an accurate report, settle accounts through coordinated efforts. There are two types of netting: bilateral netting system and multilateral netting system. Bilateral netting system, it involves transaction between parent and subsidiary or between two subsidiaries. And multilateral, each affiliated nets all its inter-affiliate receipts against all its disbursement. It transfer or receipts the balance on the position of it being a net receiver or a payer, thereby resulting in saving in transfer and exchange cost.